Let's look at question 2. Question 2 focuses on overhead absorption. Okay, so again, good exam technique would mean that we read the requirement firstly, and the requirement asks us for the actual fixed production overhead incurred in the period. So the actual overhead incurred is what we're looking to calculate. Okay, if we read through the question text, it says to us, a company has over-absorbed fixed production overheads for the period by 6,000. So over-absorbed would say to me that they have absorbed too much of an overhead. The overhead that they'd absorbed is too high. The fixed production overhead absorption rate was $8 per unit, and that was based on a normal level activity of 5,000 units, and the actual production was 4,500 units. So we need to know what information from the question is relevant. Okay, if we're asked for the actual fixed production overhead incurred, we need to calculate what we have absorbed as a fixed production overhead. And what we would have absorbed as a fixed production overhead is the actual units times the overhead absorption rate. So therefore, the actual production overhead absorbed will be 36,000. We are told in the question that we have over-absorbed 6,000. So as we said, over-absorbed means that we have absorbed too much of an overhead. So we would want to deduct that, and deducting that would allow us to calculate that the actual fixed production overhead incurred in the period must therefore have been $30,000, and therefore the correct answer is answer E. Okay, let's look at question 6. Question 6 focuses on the important area of marginal costing profit. Marginal costing is an area that is likely to come up in the exam, and therefore it's important that you're able to calculate the marginal costing profit. Okay, so if we think about some exam technique, the first thing that we should always do is read the requirement. So if we look down to the bottom, so again, no point going through the scenario until we know what we're being asked to calculate. So if we look at the requirement firstly, it says to us, what is the marginal costing profit for the month? Now, marginal costing is the accounting system in which variable costs only are charged to cost units, and then fixed costs are written off in full against contribution. So one of the key things that you need to know for marginal costing is that it focuses on contribution. Okay, so just to remind you, contribution is where we take our selling price, which we're given in the question, and we deduct the variable costs only from that selling price to get to contribution. So if we look at the list of details for product Z, we can see that direct materials, direct labour, and the variable overhead will all be recorded as variable costs. So we need to calculate the contribution per unit, and then we need to multiply the contribution per unit by the number of units that have been sold in the month. Okay, so you can see what I'm doing with the exam technique here is I'm pulling out the relevant information from the question, and that will therefore aid me when I start to do the calculation. Okay, let's look at pulling the numbers together then. So you can see that it's laid out very clearly for you in the solution. It's noting what we wanted to do. We said we wanted to calculate the contribution per unit, and then to get the contribution for the month, we would multiply the contribution per unit by the number of units sold in the month. So you can see that we've taken the selling price of 30, we have deducted the variable costs only to come up with a contribution per unit of 14, and then multiplied that by the number of units sold in the month. Yep, so not produced, but the number of units sold in the month, to calculate our contribution in total for the month. The question didn't ask for contribution, the question asked for our marginal costing profit. So therefore the final thing that we have to deduct from there is the fixed overheads incurred in the month, which we were told in the question. So finally, deducting the fixed overheads of 27,400 would leave us with a marginal costing profit for the month of 45,400. If we look at the response options that are available, the correct one would be response option A. So the marginal costing profit for the month is 45,400. Okay, let's look at question 7. Question 7 again focuses on the difference between absorption costing principles and marginal costing principles. So just to remind you, marginal costing will value inventory at variable cost only, whereas your absorption costing will value inventory at the full production cost. So let's look at the requirement to question 7. Question 7 asks for by how much profit calculated using absorption costing principles will differ from the profit if marginal costing principles were used. So under absorption costing principles, we're going to include the fixed cost when we value the inventory. However, under marginal costing principles, we're going to look at variable cost only. And that's the key thing to know. That's the key technical knowledge to be aware of if you're looking at a question asking for the difference between absorption costing and marginal costing. Okay, so the question tells us that the company made 17,500 units and the total cost was $16 per unit. It then tells us that 3/4 of the costs were variable cost, so therefore we can say that the variable cost must be 12, and 1/4 of the cost is a fixed cost, so we can say that the fixed cost must be 4. If we read on, we're then told that 15,000 units were sold and were given the selling price, and there were no opening inventories. So if we produced 17,500 units and sold 15,000, there must be 2,500 units remaining in inventory. Under absorption costing principles, the difference between that and marginal costing is that the fixed cost of $4 per unit will be carried forward in the inventory valuation. So therefore, under absorption costing principles, $10,000 in total will be carried forward in the inventory valuation and therefore will not be charged to profit in the current year. Profit will therefore be 10,000 higher due to the fact that these costs are carried forward in inventory, and therefore the correct answer would be response option B. Knowledge topic 6 looks at project appraisal. There are a number of different investment appraisal techniques that we cover in F2, one of them being payback. And question 11 asks you to calculate the payback period of a project. It actually asks you to calculate what we call the discounted payback period. So again, if we look at the requirement firstly here, it says what is the discounted payback period of the investment project. The discounted payback period needs to be based on discounted cash flows. It tells us in the question that this is a company who has a required rate of return of 10%. So looking at the information that we're given in the question, let's get rid of what is not relevant to us. So we don't need the column with the discount rate at 0%. We don't need the column with the discount rate at 20%. What becomes important to us are the discounted cash flows generated by the project at a discount rate of 10%, because that is the company's required return. Now, just to remind you, the payback period is the number of years that it takes for the project's cash inflows to pay back their outflows. So what you might find useful to do in the exam is to jot down to yourself a running total of the cumulative cash flows generated by the project for each year. So let's see what we mean by that. So in time period 0 at the start of the project, there's an investment of 90. So I have a cumulative cash outflow of 90. In year 1, we have a cash inflow of 27.3. So if we add that on, so we have 90 of an outflow, we then have 27.3 coming into the project, which would give us a cumulative cash outflow of 62.7 at the end of year 1. We continue with that, so at the end of year 2, so again we have another 24.8 cash inflow coming in, so a cumulative cash outflow of 37.9 at the end of year 2. We then add on the year 3 cash flow of 22.5, which gives us a cumulative cash outflow of 15.4 at the end of year 3. And then if we add on the year 4 cash flow of 20.5, we can see that the project turns positive between years 3 and 4. So adding on the 20.5 cash flow allows the cumulative cash flow to turn positive, and it would turn positive between year 3 and year 4. So therefore, if we look at the response options that are available to us in the exam, we would want to choose one that says between years 3 and year 4. So therefore, the correct answer would be C. Question 13 asks us to calculate the present value. So if we look at the requirement, it says to us, what is the present value of 10 annual payments of $700? The first one being paid immediately. So remember, being paid immediately means in time period 0 and being discounted at 8%. So 8% is the discount factor that we have to use here. Okay, a reminder of some of the basics. So when we're asked to calculate the present value of something, we take the cash flow and we multiply it by the relevant discount factor that suits the time periods and interest rate given in the question. So firstly, we can slot in the cash flow. The cash flow is an annuity of $700. So there's 10 annual payments of $700. And because it's paid immediately, we just need to be a little bit careful with the cash flows. So instead of being time 1 through to 10 for the 10 annual payments, because it's paid immediately, it's time period 0 through to time period 9. So 0 through to 9 would equate to the 10 annual payments. Okay, so when calculating the discount factor to use here, we need to remember that the discount factor in time period 0 is always equal to 1. And then the discount factor for time periods 1 through to 9, so the remaining 9 payments, we can get from our annuity tables or our cumulative present value tables. So if we look at time periods 1 through to 9 on the annuity table at an interest rate of 8%, we will see a discount factor of 6.247. If we add that to the 1, being the discount factor for time period 0, it gives us a total cumulative discount factor of 7.247. And that will account for the 10 annual payments from time period 0 through to time period 9. To finish off the calculation, if we multiply the cash flow, which is $700, by the cumulative discount factor of 7.247, it would give us a present value equal to $5,073. Looking at the response options, the correct one would be response option D. Question 14 is on discounting. Discounting is an important area of the syllabus, and it's likely that you will see a question on discounting in the F2 exam. What they can do in the exam is they can ask you to play about with the different relationships that can appear in discounting, and therefore it's important that you're comfortable with the main concept of discounting. So just to remind you of that, the present value of something is equal to the cash flow multiplied by the discount factor. Yeah? So if you were asked to calculate the present value, you would take the cash flow and you would multiply it by the discount factor. What they can also do is ask you to play about with that relationship and maybe identify what the cash flow is if they've given you the present value and the discount factor, or alternatively ask you to calculate the discount factor having given you the present value and the cash flow. Okay, so let's look and see what question 14 asks us to do. So if we read the requirement firstly, it asks us to establish what is the rate of interest used. Yeah, so the rate of interest used will be the discount rate, and therefore this is a question that is asking us to establish the discount factor. Okay, let's read through. It says an investor is to receive an annuity of $19,260 for 6 years. So remember that an annuity is a constant annual cash flows for a set period, and here that period is 6 years, and it commences at the end of year 1. And remember, that's the assumption that your discount tables always use. They always assume that the first cash flow is received at the end of the first year. It tells us that that annuity has a present value of $86,400. Okay, so let's slot the information into the relationship that we've jotted down. So the present value we're told is $86,400. The cash flow that we're given each year is $19,260. The question asks us for the interest rate, and we know that the interest rate is the rate that we discount at. So in other words, we're looking to establish the discount factor that has been used for the 6-year annuity. So what we can do is rearrange the information. So in other words, I want to take the cash flow and bring it over to the other side, or if you like, I'm going to divide both sides by 19,260, and that will enable me to identify what discount factor has been used. Okay, so if we take 86,400, if we divide that by the 19,260, we grab our calculators, that means that we must have used a cumulative discount factor of 4.486. It was for a period of 6 years. So if you look at your annuity tables or your cumulative present value tables, and we want to read along the tables for 6 years until we see a digit of 4.486 or something close to 4.486. And if you read along your tables, you will see that the interest rate that must have been used to discount those cash flows would be 9%. So from the 6 years column on the table, we must have used an interest rate of 9%. The correct answer is therefore answer C. Okay, let's look at question 16. Question 16 looks at the relevant costing area of the syllabus. So if we look at reading the requirement firstly, which is always the best place to start in a question, what is the relevant labour cost of the contract? So to remind you, a relevant cost is one that is a future incremental cash flow or something that is caused by a decision or caused by the project. In this question, it's in relation to a contract, so we're looking at what is the labour cost caused by the contract. Let's read through it together then. A company is considering accepting a 1-year contract that will require 4 skilled employees. The 4 skilled employees could be recruited on a 1-year contract at $40,000 per employee. So that would be a relevant cost. If I went ahead with the project, my first option is to recruit the 4 employees at $40,000 each, which would therefore be a relevant cost of $160,000. It then tells me that the employees would be supervised by an existing manager who is currently paid $60,000 per annum. It's expected that the supervision of the contract would take 10% of his time. That $60,000 is not a relevant cost. It is not incremental to the contract going ahead. The manager would be paid his $60,000 regardless of whether we went ahead with the contract or not. So therefore we do not include it as part of the relevant cost of the contract. The other option that we have, it says to us, instead of recruiting new employees, the company could retain some existing employees who currently earn $30,000 per year. So again, their current wage is not a relevant cause. It is not caused by the contract. It's not incremental. They would be paid that anyway. However, they would have to be trained, and it tells us that the training would cost $15,000 in total. Yep, so not per employee, but in total. And if these employees were used, they would need to be replaced at a total cost of $100,000. So therefore, the incremental training cost is relevant. It's caused by the decision to go ahead with the contract. And if we use existing employees, we would need to replace them at a cost of 100,000. And again, that is incremental. It's caused by the decision to use these employees on the new contract. In total, if we use our existing employees, it would cost us 115,000. We therefore have a decision to make. So as a business, we would choose to either recruit the new employees at a cost of 160,000 or use our existing employees, which would cost us 115,000. It would make a sensible decision to pick the lower of the two options. Yeah, so you would choose to go with the least cost to the business, and therefore the correct relevant labour cost for the contract would be 115,000, which is response option A. Question 20 looks at discounting, and it specifically asks us to calculate the present value of an annuity. So again, if you look at the requirement here, it says to us, using the annuity rates below, calculate the present value of the annuity. Just to remind you of the basics, when we calculate the present value of something, we always take the cash flow and we multiply it by the relevant discount factor, which would cover the time period covered in the question and the interest rate used. Okay, let's start to read through the information then. Tilly will receive an annuity starting after 3 years. Yep, so after 3 years would say to me that the first time period is time period 4, and it will pay her 1,500 per year. So 1,500 is the cash flow, that is my annuity, and it's going to pay me the 1,500 per year for 3 years. So therefore I'm going to get it in time period 4, time period 5 and time period 6. The interest rate that we're given in the question is 10%, so 10% is our cost of capital. So therefore the discount rate that we want to use is a discount rate that will cover time periods 4 through to 6 at a rate of 10%. And we're given some annuity rates to use here. We're given the annuity rates from year 1 through to year 6. So sometimes in the exam you will have to play about with the rates in the table. So for example, in this question we have to use the annuity rate for time period 1 through to 6 firstly. So I'm going to pick up the 4.355. However, I don't want time period 1 through to 6, I only want time period 4 through to 6. So therefore what I need to deduct from that is the first 3 years. Yeah? So I want to deduct the annuity for time periods 1 through to 3, which is 2.487. So that I'm left only with the relevant time periods that we need for the question, which are time periods 4 through to 6. Okay, if we deduct the cumulative discount factors from each other, we're left with a residual of 1.868, which will account for time periods 4, 5 and 6, which is what we need to answer the question. So if we take the cash flow of 1,500, we multiply it by the cumulative discount factor for time periods 4, 5 and 6, and that would give us a present value in total here, if we multiply the two together, of 2,802. The correct response option is therefore response option B. Okay, so I would be comfortable with playing about with the different time periods here. So using the information that you're given in the cumulative present value tables, but manipulating that information to drop out the time period that's relevant to the question. Question 24 looks at flexed budgeting. Let's look at the requirement firstly. What would be the total cost? So we'd ask for the total cost in a budget that is flexed at 77% level of activity. Let's look at the information we're given in the question. CA Co manufactures a single product and it has drawn up the following flex budgets for the year. We have the information for direct materials, direct labour, production overhead, other overhead and the total cost. And we're given that information at 3 different activity levels. Some of the costs will be variable costs and some of them will be fixed costs. So the first thing that we have to do is we need to establish the cost behaviour for each category of cost. It's likely that direct materials and direct labour are variable costs, but we're going to check that in a wee second using something called the high-low method. The production overhead could be variable or it could be a semi-variable cost, so there might be a fixed element included in there. But what we can identify straight away is that the other overheads are obviously a fixed cost. They do not change, they stay constant as the level of activity changes. Okay, so let's identify firstly the variable cost of direct materials. So as I said, using the high-low method, what we can do is pick the highest level activity and the lowest level activity and look at the difference between the two. So for direct materials, we can see that there is a difference here of $40,000 between the 80% activity level and the 60% activity level. So if we take that $40,000 and divide it by the 20, being the 20% difference between 60 and 80, it will drop out that it is a cost per unit of 2,000. And we can check that that is a purely variable cost. If we look at the 60% activity level, so if we went 60 times 2,000, it would equal the 120,000. And likewise, if we went 80 times 2,000, it would equal the 160,000. So direct materials are a variable cost. We can do the same for direct labour. So again, if we take the difference between the highest and the lowest levels of activity, we'll have 30,000. Again, if we divide that by 20, being the difference in the activity level, we can see that direct labour has a variable cost of 1,500. Again, a quick check, if we did 60 times the 1,500, it would give us the 90,000, and the 80 times the 1,500 would give us the 120,000. So we've established the cost behaviour for direct materials and direct labour, that they are both variable costs. Let's look at the production overhead next. So again, using the high-low method, the difference between the two highest and lowest levels of activity is a cost of 8,000. If we divide that by 20, we get $400 per unit. Again, if we look to establish the cost behaviour here, if I did the activity level of 60 times the 400 per unit, that would say to me that there is a variable cost element of 24,000. And again, if we do it over here for the 80% activity, if we did 80 times the $400, that would give us a variable cost element equal to $32,000. We can therefore see that the production overhead is a semi-variable cost. Yep, so there is a fixed proportion included in there. Included in the production overhead is a fixed element equal to 30,000. Yep, so the 30 plus the 24 would give us the 54,000. And again, a fixed element over here of 30,000, because the 30 plus the 32 would give us 62,000. Okay, now that we've identified the cost behaviour for each item of cost for the company, we can now flex the budget at a 77% level. So for direct materials, we would take our 77 times the unit cost of 2,000, which would give us a total direct material cost of 154,000. For direct labour, if we take the 77 times the variable cost of 1,500 per unit, we would have a direct labour cost flexed to 115,500. For our production overhead variable element, if we take the 77 and multiply it by 400, it would give us a variable element of 30,800. If we add on to that the production overhead fixed element, which we established was 30,000, given that production overheads are a semi-variable cost. And then finally, if we add on our other overhead, we call that OO, our other overhead was a fixed cost of 40,000. And if we grab our calculators and add it all down to answer the question asked for the total cost. So if we cast down our end column, it gives us a total cost of 370,300 when we flex it to a 77% level of activity. We look for the response option that matches our answer, and the correct answer is answer B. Question 25 tests your understanding of flexed budgeting and also your understanding of variance analysis. Let's look at the requirement firstly. So it asks us for what is the actual activity as a percentage of the fixed budget last month. So what is the actual activity as a percentage of the fixed budget last month? Okay, let's read through the question together. A company uses flex budgets. The fixed budget for last month, based on 100% activity level, showed a direct cost of $100,000. Last month's actual direct costs were compared with the flexed budget to show the following. So we had an actual direct cost of 93,600 and an adverse variance of 2,400. Now that adverse variance is compared to the flexed budget. So therefore we can use that information to identify what was the flexed budget for direct costs. So if we had an actual cost of 93,600 and a 2,400 adverse variance, it means our actual costs were greater than our flexed budget by 2,400. So we can therefore say that our flexed budget must be equal to the 93,600 actual costs less the adverse variance of 2,400. So we must have had a flexed budget of 91,200. At 100% activity, we had costs of 100,000. Yep, so we just note that down here. At 100% activity, our costs were equal to 100,000. We've flexed our budget based on the actual activity, and that flexed budget has a cost of 91,200. So therefore, our actual activity as a percentage of the fixed budget must be 91,200. The response option that matches our answer is response option E. Question 28 tests your understanding of variance analysis and also how to interpret the results of a flexed budget. Let's look at the requirement together firstly. What the requirement asks us for is it asks what was the expenditure variance for last month. So what was the expenditure variance in total for last month? Let's look at the information that we're given in the question. Okay, Misty's budgetary control report for the last month is as follows. We have the fixed budget, the flex budget and the actual results, and we're given it for direct costs, production overhead and other overhead. We asked for the expenditure variance in total, so therefore we're going to look at total expenses. However, what is important that we know is that when we look at variance analysis, we ignore the fixed budget and we compare the flexed budget, so therefore flexed for the actual units of production, and we compare the flex budget to the actual results. So if we're looking at the total expenditure variance, we are comparing the 130,855, which was our expected or our flexed budget expenditure, to our actual results, which were higher, So we have a difference of 2725, and given that our actual results are higher than our flexed budget, it's a 2725 adverse variance. We look for the response option that matches our answer, and the correct answer would therefore be answer D. Let's look at question 29. Question 29 is a question that's asking us which of the following statements is the correct one. So let's just look down at this style of question here. Okay, so it's a multiple choice question. Which of the following statements is correct? So firstly, budgeted production volumes were achieved during the period. Well, we can see that the first statement is not correct, and the reason that the first statement is not correct is our budgeted production volumes were not achieved during the period. Our budgeted production volumes based on our original budget were 11,200. What the flexed budget shows is it flexes the results to show that we did not achieve those production units. Our production units were 9,500 lower. So to enable us to have a meaningful comparison with our actual results and a budget, we flex that budget to show that we produced a lower amount, so 9,500, which will therefore make our variance analysis more meaningful. But the budgeted production volume of 11,200 was not achieved during the period, so therefore the first statement is not correct. Statement number 2, or response option B, states that the direct labour is a variable cost. So let's look to see what happens to direct labour as our units changes. So again, if we compare the original budget to our flexed budget, if we take the $66,000 of direct labour costs and divide it by the 11,200 of our original budgeted units, that would give us a direct labour unit cost of $5.89. Let's look and see what happens when the number of units falls to 9,500. Well, our costs now fall to 57,500. If we divide that by 9,500, we can see that our unit cost is not the same. It is 6.05. So direct labour is a semi-variable cost because it looks as if there's some sort of fixed cost included in there. So again, we can see that statement B is not true. Let's look at statement C. The actual selling price per unit exceeded the standard selling price per unit. So to compare the two, we would want to compare our flexed budget revenue to our actual revenue that we achieved. Now, our flexed budget revenue based on 9,500 units, we would have expected to receive revenue of $190,000. We received more than that, so we've still sold the same number of units because we can see that they are identical here. Yeah, so we've sold the same number of units, but we've managed to achieve a higher sales revenue. Therefore, that can only have happened because our actual selling price exceeded our standard selling price that we would have used in the flex budget. Therefore, statement C is correct, and response option C is the correct answer. Let's prove that D isn't correct. So finally it says direct material cost savings were achieved against the budgeted cost allowance. Well, direct material cost, if we look at that line here, so my actual direct material cost of 57 is higher than my budgeted material cost. So therefore, again, I can conclude that response option D is not correct. Okay, so the correct answer would be C. Question 43 is from the performance measurement part of the syllabus. This area of the syllabus could test your understanding of any of the ratios, and you could be asked in a question to calculate a number of different ratios. Question 43 asks us to specifically calculate a ratio called the return on capital employed. And return on capital employed is a key ratio and one that I would definitely be comfortable with in your F2 paper. The question asks us to calculate it as a percentage, and a percentage stated to 1 decimal place for both years. Return on capital employed, so the ratio itself helps you with the calculation. So return means our profit, and it's our profit from running the business on a day-to-day basis. So it's always our profits before interest and tax, or what we call our operating profit. We divide that by our capital employed. Capital, the word capital implying the money employed, implying invested. So in other words, the money invested in the business, and you will either be given that number in the question or you will have to calculate it by adding together the company's long-term debt plus their equity. Yeah, so capital employed is the money invested in the business, so the long-term debt plus the equity. Let's apply it to question 43. So we're given a company's results for the last 2 years. We're given year 1 and year 2, and we're asked to calculate ROCE for both years. So if we read down the extract from their income statement, we have sales and a list of different expenses. So bearing in mind that we want operating profit, or our profit before interest and tax, we want to use the net profit figure down here. There is no interest or tax included in the list of expenses. So we take our sales less all of the expenses listed to give us our operating profit. And we're also told, we don't have to calculate, we're already told the average capital employed for the year. We take one over the other to calculate our ROCE. So our ROCE for year 1 is the 1045 divided by the 13,000, which is 0.08. We're asked to quote it as a percentage to 1 decimal point, so that would be 8.0%. For year 2, we take the 1372, we divide it by the 12,000, that would be 0.114, and again quoted as a percentage would be 11.4%. Okay, this would be indicative of what we would call a numerical entry question, so it's important that we follow the instructions. So calculate it as a percentage to 1 decimal place. So what we would plug in for our year 1 answer is we would type in an answer of 8.0, and for our year 2 answer we would type in an answer of 11.4. Question 44 is from the performance measurement area of the syllabus, and it tests your understanding of return on investment and residual income being used as performance measures. Let's look at the requirement firstly. The question states, based on the return on investment and/or the residual income criteria, would the project be accepted? So there are 2 different performance measures that we are testing in this question: return on investment and residual income. Okay, let's read it through together. Division A of Egg Birth Co is considering a project which will increase our annual net profit after tax by 30,000, but it will require average inventory levels to increase by 200,000. So that's the information that we need for return on investment. So the return on investment is the profit that the project generates, so it will increase profitability by 30,000, but we require an additional investment, an investment in inventory of 200,000. So if we take one over the other, the project will have a return on investment of 15%. If we read on, it tells us that the company's current target rate of return on investment is 13%. So if we have a target of 13 and this is a project that generates a 15% return, then based on return on investment, we will accept the project. So we now know that response option C cannot be correct and response option D cannot be correct. Okay, so we need to decide between A and B now. And to do that, we're going to have to calculate the residual income. The residual income is where we take the profit generated by the project, which is 30,000, and we deduct from that what we call an imputed interest. Now, it tells us how to calculate the imputed interest. The imputed interest is to be calculated at a cost of capital of 12%, and that 12% is applied to the capital employed in the project, or the additional investment required for the project. Now, the additional investment required for the project is the 200,000 inventory. So if we take 12% of the 200,000, it gives us an imputed interest of 24. We generate profit of 30. We deduct the imputed interest of 24, which gives us a positive residual income of $6,000, which again would allow us to accept the project. So based on ROI and RI, yes, we would accept the project, and therefore the correct answer is response option B. Question 47 tests your understanding of residual income and return on investment. The information, however, is presented in a slightly different format from what you may be used to seeing. This could come up in the F2 exam, and it is a good way that they can test your understanding of the definitions of residual income and return on investment. Let's read through the question together. A division has a residual income of 480,000. Now remember that residual income is your profit less the imputed interest, and it tells us that the profit before the imputed interest was 1280. Well, if I have residual income of 480,000 and profit before the imputed interest of 1280, that can say to me that therefore my imputed interest must be the difference between the two. I must have deducted an imputed interest of 800,000 from the 1280 to be left with my residual income of 480,000. I read on, and it also tells me that the company uses a rate of 10% for computing imputed interest on its invested capital. Well, if I have an imputed interest of $800,000 and I have used a rate of 10% on my invested capital to get that $800,000, well, if I divide that by 0.10, 0.10 being the 10%, I can therefore establish that this is a company that must have had capital employed of $8 million, or invested capital of $8 million. What the question asks me for is what is the return on investment. The return on investment is the profit of the company, so the net profit of 1280, which we were told earlier on in the question. Yeah, so return on investment is your profit on the top for your return, and then your investment on the bottom, which we've just established, was 8 million. So if I take one over the other, this is a company that has generated a return on investment of 16%. The correct answer is therefore response option D. Question 49 is from the performance measurement area of the syllabus, and it tests your understanding of return on investment and residual income. It's a question that asks us which of the following statements is true. So therefore it is a good idea to cast your eye over the statements firstly so that you know what you're looking for as you start to read through the question. So response option A asks us, the revised divisional return on investment will be below 20% and the manager will make a goal congruent decision. And then the other response options, the wording is changed slightly. So response option B, the revised divisional return on investment will be above the 20% and the manager will not make a goal congruent decision. C, the return on investment will be below and the manager will not make a goal congruent decision. And D, return on investment will be above and the manager will make a goal congruent decision. So from reading the statements, we now know that we have to establish what divisional return on investment is, and we also have to establish whether the manager makes a goal congruent decision, and that is one that is in the best interest of the company. Okay, let's start to read through the question text then. So Division B of a national house building group is predicted to earn profits of 4.5 million in the current year based on its capital employed of 25 million. So we can do a first quick calculation of return on investment to see what it is at the moment, and return on investment is 18%. Yeah, so the profit, the return of 4.5 on the investment, the capital employed of 25 million. The division has been set a target return on investment of 20%. So at the moment it is failing to achieve its 20% target. We are told that the manager of Division B is considering disposing of some slow-moving houses. They have a full market value of 16 million, so that's what we could sell them for at market price. They are held in the books at a cost of 12 million. That cost will be included in the capital employed figure, and he's thinking about selling them for a reduced figure of 14 million, so at below market price. So let's look and see what would happen to return on investment if the decision did go ahead. So the impact on return on investment, well, we need to look at the impact on profit firstly. So if we think about profit, at the moment profit is 4.5. If he sells the house, he will sell it for 14. It is held in the books at 12. So he will make a profit of 2, so therefore profit will increase to 6.5. Capital employed will fall. It is 25 at the moment. We will remove the house which is held in the books, or the houses, which are held in the books at 12 million, which would leave us with capital employed of 13. So therefore our return on investment after the decision would change to 6.5 divided by 13, which would give us a return on investment of 50%. Yeah, so that means that the division would now be able to meet or exceed its target. They are selling the houses for a reduced figure of 14, whereas the market value, what they could have sold them for, was 16. So therefore this is a decision that would not be in the best interest of the company. We're losing out. We're not selling the houses for as much as we could have. However, it's a decision that the manager of Division B would want to make so that he makes sure that he meets his own performance targets, because it would enable his division to meet or exceed the target return of 20%. Okay, so let's look at the statements to identify which statement is true. So statement A says the revised divisional ROI is below the 20%. Well, we know that that's not true because it's above the 20%. We therefore also know that statement C is not true for the same reason. Reading statement B, the ROI is above 20%. Well, that is true, and the manager will not make a goal congruent decision. We also know that that statement is true because we've said that he's sold them for below market price. Therefore, the statement that is true is statement B. Finishing off, we can say that statement D is not correct, and the reason that statement D is not correct is because it states that he will make a goal congruent decision, and we know that that is not the case. So the correct answer would be response option B.